Hey, everybody. It's wonderful to be back. Kelly, Cam, Lachlan, what an honor to be back. And all of you participating around the world, it is truly a delight to be back part of this IDTA community. What I'm delighted to share with all of you is that I have a very beautiful community over here, largely in the US, but also in Australia, New Zealand, Germany, France, all across Scandinavia, some Canadians. We've got a great group of people who have actually joined in on this conference so that we can actually start cross-pollinating our communities. And Kelly, Cam, and Lachlan, thank you so much for opening that opportunity. I know that we all value it, and it's an honor to be back here again. I figured that it would be a great place to start. And as you all know, my commitment in a presentation like this is to try to bring some conversation into a sharp focus around maybe some of the things that are not commonly known, commonly considered, but I think are really essential in terms of having us understand where we sit in the long arc of our economy, where we sit in the giant transition that, as we talked about last year, is unfolding in some very unusual ways. I love that we have at the beginning of a presentation like this, that beautiful disclosure that we have to make, which is about looking at the past and looking at where we think the future is going. And it's really critical in these times to understand that there are some fundamentals that are happening right now in the global economy which are structurally different from times past. And so while that disclaimer feels like it's pro forma, and it is, to be clear, it's also important to realize that one of the things that we all have to keep in mind is that the conditions that are surrounding us globally are in fact changing dramatically. And while we can talk about episodic events like COVID-19, like trade disruptions, like the movement of people that obviously has been impacted by the recent events, there are structural issues at the macro level that we're going to talk about today, which have altered the game. And like every other major opportunity, what I want to make sure you're clear on is that if you take nothing else away from this presentation, my goal is to work with you to have and build your awareness of what are those weak signals, what are the things that we should be watching, what are the indicators that we should be thinking about, where if we see something transforming in the reality that we're engaging right now, how do we put ourselves in a position of understanding what are the signals we should be monitoring for, and what are the things that those indicate in terms of where we might want to allocate or put our time and effort, or at least start asking a new set of questions. So I figured there was no better way to start than a little Kenny Rogers, the gambler. And what I love about that is that story ends kind of in a very bizarre, kind of dark, but slightly tragic way, where the gambler and Kenny are sitting on a train and they're having this late night conversation. In the end, obviously, as you know, the gambler winds up dead. So that's not where we're going to go with this conversation, but it's important to point out that the story in that song has a whole bunch of really critical components. But my favorite line from the gambler, Kenny Rogers, the gambler, is every gambler knows that the secret to surviving is knowing what to throw away and knowing what to keep. And before we dive into the meat of the presentation, I want to unpack the last phrase, knowing what to throw away and knowing what to keep. And I want to invite you to consider over the course of the next hour that one of the things that we need to think about throwing away is old regression-oriented predictive models. And I'm going to go through the reason why I'm going to recommend that we throw those away. We need to throw them away for a bunch of reasons, but I'm going to geek out for a moment before we dive into the presentation. Because one of the things that we have to understand anytime we look at statistics, and it doesn't matter what the statistic is, and it doesn't matter how we go about using them, it is vital that we understand that when assumptions that support models change, we need to ask the question whether the changing assumptions and the changing conditions actually are robust enough to affect whether models work or not. Now, I'm going to criticize, as you can imagine, what most central banks are doing as an example of this, or for example, what the president here in the United States has been saying lately, where he can say out of one side of his mouth, we're going to spend $2.3 trillion and it's, quote, not going to cost anything. His words are precisely, we're going to spend $2.3 trillion and it will cost the taxpayer zero. And he's now recited zero many times. Now, you should pause and reflect on how one can, on the one side of the equation, say, I'm going to spend $2.3 trillion. And on the other side of the coin, say it's going to cost zero. I don't know about you, but I don't have $2.3 trillion in my portfolio. And I don't know exactly what it would feel like to have $2.3 trillion in my portfolio. But when I hear somebody say, hey, you can actually spend all of it and it's going to cost nothing, something about that actually feels disingenuous because, as you all know, if it's nothing more than moving capital, I have transaction costs, I have opportunity costs. So the idea that you can actually say, we're going to spend $2.3 trillion, it's going to cost zero, is a weak signal in the market that says that President Biden here in the United States and the allocators of where we spend our money on Capitol Hill here in the United States are in fact dealing in a altering reality. They're dealing with a change dynamic. And as we go into this presentation, I just want to encourage you to think about how the information I'm sharing is actually going to impact your models. And because of that, I spent a lot of time listening to, are you ready for this? Kelly, Cam, and Lockie. I spent a lot of time listening to what they say, what they do, what their recommendations are, the kinds of insights that they share. And I decided to make sure that I have helped add to each one of their recommendations, their teachings, and their methodologies, information that will in fact add to the robustness of how to deal with their models moving through this phase of very interesting dynamic market conditions. So let's jump in. And by the way, I apologize in advance. I'm going to keep the gambler theme going the whole way through the presentation. So let's start with somebody's rigged the table. Now, what do I mean by somebody's rigged the table? There are simple ways to describe this phenomenon, and there are slightly more complex ways. And so I'm going to unpack both of them. But if we look at the very simple question of supply and demand or inventory of tradable elements in the marketplace, it's important for us to understand that we hit a peak in the mid-2000s. We hit a peak on the growth of liquid tradable shares worldwide. If you look at the chart that I have on the left, what you'll see is that across the entire world, we had a massive expansion of liquid and tradable equities that actually peaked somewhere around the mid part of 2015 to 2016. And what we saw is that we had this liquid capital that started flowing into the market after the 2005 to 2008 time period, after the banks started liberalizing post 2001, started liberalizing the flow of capital. We started seeing a peak of capital floating out into the market. But you see that in the graph that we have on the screen in front of you, we have this period, which was the growth period leading up to 2008, where we had an amazing expansion of liquid tradable equities. And what that meant was worldwide, companies were putting shares out into the marketplace at an alarmingly high rate. And you'll notice that that rate, as you can imagine, in 2008, collapsed. And it collapsed very rapidly. But if you look at what happened beginning in 2010, we've gone through a couple of cycles, but it's important for us to look at the GFC happens in here. And then we're sitting at a place where the entire tradable securities in the world are down about 2/3 from when they were at the peak in 2007. They're down 2/3. Now, what does that actually mean in a supply and demand dynamic? If I know that the total liquid inventory of an asset class has reduced by 2/3, I'm going to expect to see a couple things change. The first thing I'm going to see is I'm going to see that the relative price per unit is going to be inflated. So growth, if you will, in the value of an asset is actually not because the asset is gaining value. It's because the total tradable securities have decreased in their existence. Literally, we've shrunk the pool of assets. And as a result, with the same amount of money trying to chase a finite pool of assets, as we shrink the pool of assets, we actually find out a very interesting challenge. The interesting challenge is the direct result of shrinking the number of available assets is that we actually have an expansion of price. Does that mean that we have an expansion of value? And I want us to put a pin in that because I'm going to come back to it, because it's important to realize that what is happening is a dynamic that's the convergence of two phenomena. And this is a very important observation that we actually harm ourselves if we don't take seriously. Because what we'll see very quickly in our view of the world is that as we see this collapse on this first graph of the total number of tradable securities overall, on this right-hand graph, we see stocks traded as a function of the gross domestic product of the world. And not surprisingly, we see in 2000, 2005, 2010, 2015, in this right side graph, that stocks have in fact hyperinflated their value, not based on reality, but based on corporate redemptions. The biggest reason why we see the shrinking pool of equities in the marketplace is for two functions. One, cheap capital. As the cost of capital has dropped, there have been a lot of incentives in place for companies to repatriate their stock, meaning that they are in fact taking their entities' equity out of circulation. And a lot of that is driven by a convergence of two factors. One is the cost of money. So as leverage becomes cheaper, stock buybacks become more desirable. And that's one of the things that drives the illusion of value. But the other problem that we have to look at is we have to look at the GDP function, and that the gross domestic product function, as we look at how we intersect a world that says, how is the market really moving versus how much of that market move is structural, meaning there's resource, productivity, output behind it, versus how much of that growth is a function of economic policy manipulation. We see that right now we're heading in a very negative trajectory. The entire world is actually falling off the cliff when it comes to the value of tradable equities to the underlying GDP. And this is actually quite a troubling phenomenon. You'll see that we have these moments of interventions in our right-hand graph, but it's critical for us to look at the trajectory of what we're on right now, which is that with all of the liquidity and all of the money and all the monetary policy that we pumped into the economy, there's an alarming piece of information that comes out of this right-hand graph. And that is companies are investing in corporate and financial structure activities rather than investing in their productive futures. By the way, if you look at the earnings cycles of the last 2 quarters, you'll see this is borne out. The amount of money being reinvested in the building and developing of new productive platforms in most corporations around the world is actually going down at a very time when the cost of capital theoretically is most attractive. Presented with their alternatives, companies are actually doing financial engineering to create the illusion of the value creation instead of investing in the infrastructure, the R&D, the development of new products, the development of new services. They're actually investing in the wrong direction. They're investing in structural financial engineering, and they are investing less in the actual ability to link their business, their enterprise, to future productivity. Now, what that means, so let's just make sure we unpack it. What that means is one of the things that an astute trader is going to look into is actually non-financial engineering success. What does that look like? That looks like strategic value chain merger and acquisition activity. Am I actually getting companies that are starting to do M&A activities that are bringing resources together? And where do you want to be as a trader in that dynamic? Well, where you want to be is in the acquiring side of that. So understanding what kind of companies are dynamically involved in supply chains, in logistics, in energy delivery, in the ability to make and stabilize and produce automation systems and robotic systems and computer systems. Those are things that are part of the growth economy, and some part of a portfolio could be very wise to consider. How do we amplify our space into understanding that these potentially smaller or mid-cap players around the world are ultimately going to be the ones who are going to be on the next cusp of the M&A premium awards for being critical in the supply chain and infrastructure of global enterprise. One of the things I encourage people to do is actually look at what the business is doing with their statements on internal spend, the renewal of their infrastructure, or their expenditures in R&D. Those two things are part of the pro-GDP, pro-growth, pro-accretive space. And one of the things to be very careful of is companies that have historically relied solely on financial engineering to manage their way through the last 10 to 15 months, because those companies are probably going to run into some headwinds given the fact that monetary policy has to change. Now, the next question, which is another, once again, gambling metaphor, did the house, and this by the way is a rhetorical question, but did the house buy the bank? Now, it's always difficult to figure out exactly how best to tell this story. So I'm going to try to tell it through two pieces of graphics. The graph on the left is actually quite important because, as you see, there is something that does not appear to live comfortably inside of what we would expect to see in a linear regression model. If we were actually playing in reality, we would expect to see the two lines, producer price index by commodity and consumer price, we would expect to see those lines relatively equivalent over time. And you'll notice that back in the 90s and even in the early 2000s, there was actually a fairly strong correlation between those. But you'll notice that during the period beginning in 2005 and going through 2011, we started to see a huge mismatch, meaning that producer prices were going up remarkably, while consumer prices were actually rather gradually inflating. And that is something that we need to understand because of what I just got done saying. When the producer price index actually starts rising, and it's rising because of commodity energy costs, what we should see is we should see that reflected in what's going on in terms of the underlying consumer price index. And the reason, by the way, why this is critical is because when you thinking about the data inputs that you might want to think about when you think about your macro strategies, you may very well want to look at the fact that we have a period of time that appears to be analogous to the period that lived between 2008 and 2011, where we have, as you look now to the right of that graph, we have a massive spike that has actually been, in terms of absolute scale, the largest growth of producer price index that we've seen over the last now about 45 years. That's a big number. But what you also see is, as we saw in 2007 and 2008, going into 2009, we see a greater than expected increase in consumer price index. And by the way, this data was run before we started seeing significant supply chain shortages and any energy prices go up. So this graph, quite literally, that I put together for this slide presentation just a few weeks ago, has actually gotten worse since I did the slide. Now, what is the problem inside of the convergence of when we see producer price indexes skyrocket and we see the actual consumer price go on an upward inflection that goes at a rate right now that is relatively unprecedented? What that means is that we're going to be in a situation where the ability for the discretionary income linked businesses, so consumer products, things where we expect to see kind of a relatively high turnover, so non-durable goods manufacturers, what we have in those environments is a situation where the producer price burden cannot be shifted all the way into the consumer space, which means we're going to see some performance compression. And the performance compression is going to hit us at a very difficult time in the year. If we think about the Northern Hemisphere markets, as all of you are familiar with, Northern Hemisphere markets look to the fourth quarter as a consumer price and a consumer dynamic windfall. And it's where a lot of companies make an enormous amount of their economic gain, as much as in many instances 40% in this last quarter of the fiscal year. Now, the problem is that when you have the producer price spike and you have a flattened but growing consumer price, what you know is that you are going to have to look to the actual infrastructure, logistics, and supply chain as the place to pick up the value, and you are not going to get it at the retail and commercial level. That's an interesting dynamic. And this graph, by the way, is something that I would highly recommend you have a look at, just to keep yourself informed about how much we either have a correlated or uncorrelated dynamic taking place. Because as we fall out of correlation, we actually see that there are broad implications to the larger market. And that's actually really important to look at. But the graph on the right is the one that I want you to actually take a look at, because this is where we have to unpack an illusion. A lot of us have seen, relatively speaking, over the last 10 years, what we would describe as a secular bull market. There has been a lot of growth that we see and we say is reporting over that period of time. The downside of that observation is what happens in the graph on the right. And I gave you a long time window in this graph because I thought it would be dramatic for you to see that if we go back to 1860 with the US dollar, and the reason I'm using the US dollar is because during the 1860s forward period of time, what we see is a growing influence of the US dollar on the global trade economy, which is the reason why I'm using it as a proxy. We see that we hit a peak, which was a reconstruction peak in the turn of the last century. So in 1900, the dollar was worth as close to $1 as we could actually come up with. And that's very cool. But where we are now is that $1 in 1900 is now worth something in the order of 3.5 cents today. And if you look at what's happened in this graph from 1985 until 2021, you'll see that we are actually still on a downward trend. And that's actually something that's worth noting, because are we in fact, when we see the secular growth of what we call growth accretion in the value of the marketplace, are we actually seeing growth, or are we seeing the illusion of growth masked under the currency and the financial and monetary system functional devaluation of the tradable currencies that we're using to execute what we're experiencing in the marketplace? And the tragic irony is that the majority of us are saying, whether it's in real estate, whether it's in commodities, whether it's in equities, whether it's in credit, we're saying, oh my gosh, this has been a great run. If we actually subtract out the devaluation, the functional devaluation of the banking systems, and those being led primarily by central bank interventions who are actually buying their own debt. So they're actually kind of doing a Ponzi scheme, if we really get honest with this. If we have that going on, the question is, did we actually have secular bull markets over the last 10 years, or did we create an illusion of that by having a diminished value of our underlying trading currencies. Now, some of you would say, well, Dave, it kind of doesn't matter because at the end of the day, we're all in this together. And that is a true observation, because the fact of the matter is value of money is relative. And so if everybody's going through the same experience, then relatively speaking, we're kind of all in the same boat. And that feels like it would be a good place to find some solace until we get to our next slide, because our next slide is where the trouble hits. If we look at the relative inflow and outflow of funds and fund management, and you know that I've talked about this in our previous interactions in the last couple of years, because I always like to see where the money's actually going. On the left-hand side, you see the relative growth of inflows and outflows of where managed funds live. Now, you all know that over the last few years, large enterprises like BlackRock and State Street and Vanguard have become the world's largest shareholders, and not by a little bit. Right now, BlackRock is, softly reported to own somewhere in the notion of 7 to 8% of all tradable assets globally. That's a big number. That's a lot to control. And I'm going to unpack that a little further, but that's actually something that's worth noting, because what we used to do, and by the way, this is where we get to the punchline of what I said about the way in which we need to think about old models versus new models. When assets are held by fiduciary, long-dated asset holders, then what we need to be looking at very carefully is the movements that they are making. Because and let's take BlackRock as an example. If BlackRock is moving into or out of a position, it is doing it not based on the economic conditions of the business, not based on the economic conditions of the underlying market dynamics, not based on any of the traditional financial or behavioral models. When a BlackRock exits a position or modifies a position, what's happening is they are doing it for structural engineering reasons of their portfolio. In other words, they'll take gains and losses not based on the underlying performance of the enterprise, not based on the traditional value markers inside of the way markets traditionally work. They are going to dump or pick up assets as a means of doing their own financial engineering for a much different time horizon. And this is where it gets really critical, people, because the time horizon that they are using now has to extend at a much longer interval, because they're having to pick up gains from higher yielding assets because their sovereign assets have actually failed to keep up with their annuity requirements and their actuarial requirements. Now, I use two words, annuity and actuarial. Let's unpack what I mean by those. If what I know, as I do since 2011, that we have actually been underwater globally in the returns that we're getting from sovereign debt, which is actually historically one of the safer asset classes that people find themselves drawn into. If we know that we are underperforming serially year after year, we're underperforming what we need to perform to make sure we match liquidity to the promises that we make. If we're insurers, we're life insurers, we're pension managers, we are actuarial asset holders. So anybody who has a long dated asset requirement, as I see the intervention of central banks depreciate and decrease the returns and the yields that they're willing to offer for low risk to zero risk assets, what that does is it forces the market to actually find more risky and higher yielding assets. What we see through the index ETFs, through the index mutual funds, and actively managed mutual funds, if we actually look at what's going on in this dynamic, a very alarming trend is showing up, which is we see index ETFs, we see index mutual funds being the primary allocator of new capital, and we see outflows coming from active management. What that means, people, is that we now have a massive alteration in the structure of what is moving and the conditions in which that movement happens. And that's where the actuarial piece becomes really important, because we need to start paying attention to the market dynamics using a very different periodicity than we've been historically used to. Because once again, when an allocator is making a decision inside of an indexed passive instrument, then the decision to buy and the decision to sell are not being made by market conditions, and they are not being made by individuals. I'm so glad that Lachlan is going to talk about some of the dynamics he's looking at with these reversals and his Fibonacci sequence. And I'm really excited to hear about that, because one of the dynamics we need to look at is how macro changes in who is participating and how they're participating in the market is actually opening up some really interesting new opportunities. And I want to unpack those with the graph that I've put over here on the right-hand side. Now, this graph, by the way, is something that I have worked for a long time to help people unpack. But let's unpack it together because it's actually helpful. This is the top amount of tradable assets worldwide. And I have taken a high target of seeing if I can get a nice summary of when we think about what is in the market, what are the tradable securities, what should we be looking at in terms of our portfolio activities. You'll see at the top of the list, one of the smaller assets, silver, globally worth roughly $44 billion in worldwide silver liquidity. Cryptocurrencies, $244 billion. Global military spending, which used to dominate this chart, now at a paltry $1.782 trillion. Really not a huge amount of money now being spent on the military, and that's come in large part by the reduction of spending in many of the European countries, even though technically speaking, this number probably underreports how much China is spending right now, because those numbers aren't necessarily as robust as we'd like them to be. But look at this. US federal deficit spending $3.8 trillion, coins and banknotes 6 trillion, Fed balance sheet 7 trillion. The world's billionaires, interestingly enough, the billionaires themselves are now an asset class, which is kind of an interesting little mind bend that didn't used to be on this list, but $8 trillion. Gold at 10 trillion. But then let's look at where we go, because we have a huge, huge, huge shift that gets into a number that I don't say very often. It gets into the quadrillions. For me, I don't even know what a quadrillion is. It feels like when you say it, you should do a Dr. Evil. Quadrillions. And you need sharks with lasers to figure that one out, because quadrillions a lot of money. But if we look at what we have in the now trillions and quadrillions of value, are actually all derivatives. And I wanted you to see this slide because I wanted you to see how much notional value is actually living inside of the fact that now, for the first time that it's been reported, derivatives not only outstrip the global real estate market, but they outstrip it by almost fourfold. In other words, what we are doing, as I said before, is we are doing financial engineering and manipulation. And if at the end of the day, we actually unpack what's going on, why do we have a quadrillion dollar value globally of the notional value of high-end derivatives? Why do we have that number? Well, we have that number because, and by the way, if you learn nothing else from this presentation, this is the big takeaway. It's a little number on the slide. It's a big takeaway. What we know is that financial markets know that duration mismatch, and let me say this one more time, duration mismatch. And by that, I mean the expectation of how long an asset takes to deliver the value an investor expects from it. Duration mismatch is now the global largest financial bet in the market. That's why I use the example of a roulette wheel, because what we know is that people are making money on the misalignment of expectations of when assets will return their value versus the traditional duration that is associated with those assets. In other words, we're betting on a market volatility horizon where all of the assumptions that we used to make about what assets look like, how valuable they are, what their duration is, what their risk tolerance is, what their risk profile is. All of those bets are not only off the table, but those bets are off the table 3 to 4 to 1 over what used to be one of the largest assets by absolute dollar value, which was real estate. When we're 4 times in the world's notional value derivatives, we actually know that what we're doing is betting against each other. And that's an interesting thing to make the observation stick with, because what we know is that's an indicator of a much larger phenomenon. This, in fact, is the world saying we have no confidence in the future, which means that your opportunity right now is to ask some deeply fundamental questions about where you go when the world has said it has no confidence. So let's ask that question. Now, I'm using this lovely analogy that you get out of some great Westerns. I always love when people flash a diamond at the table, and the whole idea is you're supposed to take people off their game. There's a very interesting thing that I wanted to point out. Now, many of you know that for many years, I have run quantitative funds. The quantitative funds I run under the Purple Bridge management structure, as well as the global indexes that used to be part of the CNBC IQ 100 and now are part of the selective standards indexes. Our indexes, the Innovation Alpha indexes, INAU, INAG, and TWAR, Trade War. I want to call your attention to the most alarming piece of data that I should be quite excited about, but I'm not excited about, and I'll tell you why I'm not. Our top performing index and our top performing fund strategy has been the MCAM Global Holdings Trade War Index. Now, I very rarely do this, and I'm glad I'm doing this where I have both the IDTA team as well as a lot of my beautiful people who have been part of my ecosystem on the same story, because I actually don't pull back the curtain on how we do this particular index very often. But I wanted to give you a peek behind the curtain so that you can actually see what this particular index is really about. Let's take a step back in time. One of the things that I said when we started our US and our global equities index is that we noticed a very interesting correlation where the positions that we were modeling into our quant strategy and into our indexes were derived in large part based on innovation and what we call innovation alpha. So what does innovation alpha mean? Well, that means the degree to which a company is a thought leader, a technology leader, an engineering leader, a market position leader. We're looking for companies that have a proprietary price edge in the marketplace. And we're looking for those companies in every sector across every platform. And we want to know not only what the edge is, but how long the edge is going to last. And the reason why Innovation Alpha has been such a strong signal, going all the way back to 2008, the reason why it's been such a strong signal is because we are able to measure things that other people don't measure, because we have a data information advantage. And our data information advantage is remarkable, and it has been persistent. And the great news is we have, over the life of our indexes, outperformed the global indexes quite handily. But inside of this effort, I decided back in 2013 and 14 to start looking at another phenomenon. And this is where it gets a little more dark and a little more insidious. Our trade war index takes our global equity score and overlays a very interesting data point. The data point we overlay is whether or not a company has received a tax, a procurement, or some other concession from a major government counterparty trade. In other words, if I know that GE is favored to get contracts won in China over ABB or Alstom or Siemens, I want to know whether or not they're making that decision based on a technology or a service or an industry advantage, or whether they are getting that advantage based on favoritism where there is a relationship that is non-mercantile. I want to know, in the worst instance, whether somebody's been bribed to actually award a contract. And by the way, in some instances, we're quite literally looking at Foreign Corrupt Practices Acts, where we have situations where companies have influenced governments to purchase selectively from a subset of vendors and not from others. And when we see those advantages, we actually plug in those advantages into our scoring system. And what you'll see if we look at our global index, and I've highlighted the trade war index just below the global index, we're getting several basis points advantage above our global index performance and a full 10% above the MSCI ACWI. And that's really important to see, that we're outperforming that, last year return on MSCI ACWI, we're outperforming 10%. And that's an enormous outperformance. And we're doing it by measuring the corporate interactions with governments. Let me give you a metaphor, because that's a simple way for us to unpack this. If we know, for example, that in the coronavirus platforms that are being used right now as the delivery agent for the global rollout of the injections used to inoculate people for coronavirus, if we look at that, we'll see that inside of every single one of the Pfizer or Moderna injections is a thing called a lipid nanoparticle. Now, that lipid nanoparticle is actually manufactured and was invented by organizations at the University of British Columbia in Canada. Now, ask yourself a very simple question. When Prime Minister Justin Trudeau decided to start buying his injections from both Moderna and from Pfizer, was it a mystery that he was buying 10 times the total amount of injections required if you injected every Canadian and every moose in Canada 10 times? Or was it possible that he was actually buying all those things because there was a capital return to British Columbia because they actually benefit from the sale of each and every one of those? In other words, was his action a market action, or was it a rebate for the benefit of his economy? In other words, was he spending money to actually have that money flow back to Canada? And it turns out there appears to be a lot of suggestion in a lot of Commonwealth countries that there was, in fact, a return on value for the selection of one form of injection over another. Now, whether or not we think that's appropriate, whether or not we think that is the kind of thing that we should have governments do, I'm not going to even comment on the appropriateness of it. What I'm going to point out is that inside of our trade war index, we're looking for things where favoritism is driving corporate behavior and driving government behavior and taking market forces and setting them aside for concessions and grants of special interests coming to companies by governments. That's a really interesting thing, by the way, for us to look at. And what I would encourage you to do as you start thinking about, once again, macro ways to understand the market, is look at the ways in which companies and countries are reporting their interactions. And this becomes really important when we look at materials. It becomes really important when we look at energy. And it becomes super important when we look at manufacturing. Because it turns out, for example, that we know right now that we're in the middle of a global chip crisis. But we know that the buyers that are going to ultimately be the consumers of chip technology have most of their manufacturing and most of their chip delivery still happening through China. So it'd be a really good idea to find out which chip manufacturers have inside deals, local manufacturing favoritism, supply chain favoritism, commodity price favoritism. What are the companies that are actually gaining advantage because of the concessions that they have with foreign governments? And I'm telling you that that's not a theoretical return question. That's an actual measured return question, as you see on this graph. We have, in fact, seen an outperformance of the premium afforded to government corporate relations that is living anywhere from 50 basis points all the way up to 10% advantage. That's an enormous advantage. And now the question for you is, how do I understand how this information intersects with how I might go about trading? And the answer is simple. I encourage every single person in the marketplace to think about the ways in which you integrate the information that's coming across the news wires or wherever you're going to get information, how you integrate the information that's coming across the news wires, and then figure out, if I know, for example, that there is a chip shortage, what I know is that that means that we have an offtake limitation on the supply side. So our metals, our rare earth suppliers, all of those are actually going to have pent up demand that they are not liquidating. That means they're holding assets on their corporate side. We know the chip makers have a dynamic that's actually going to play out, which says that they are going to need to get forward contracts on their raw materials and on their energy. So I know that that's going to be required. And I know that the companies that ultimately need to sell the products that those chips go into are going to lose their price control advantage because the chip makers are going to pass along price increases to them. And what that tells me is, in every single piece of information that I can pick up on any news wire, on any press release, on any corporate statement, on any national statement, on any cross-border agreement where we have bilateral agreements between countries or country agreements with companies, what I'm going to look for is I'm going to look for any place where I see favoritism, and then I'm going to look for where in the supply chain I have arbitrage opportunities that are going to show up. Each and every one of you is so good at picking up weak signals, looking at things, building models, testing out models. And what I would encourage you to do is look at corporate to government favoritism as something that you examine going forward, because as we see the pivot of the global economy, moving away from an oil US dollar dependent system to a more global and more China-centric model where you're going to see a lot of dynamics shifting over the period of time, I think it's really appropriate that you actually stop looking at the world through 1970s, 1980s, and 1990s models, which is when we had the petrodollar hegemony in the marketplace. We're now going to be looking at a very diverse and odd set of circumstances where the enormous amount of information is going to be now coming in: power supply, metals supply, electrical engineering, and a number of other variables. And you're going to look for corporate government relations as a key driver of value recognition. And like I said, last year, our index outperformed the MSCI equity almost 10% because we're looking exactly at that phenomenon. That's an enormous, enormous outperformance. Now, to finish out the gambler metaphor, and it would just be a shame if we didn't finish out the gambler metaphor with kind of some fun little nuances. If we look at where the world is going to go with where you as a trader should at least have your eyes and ears open, it's important to realize that by total resources required for the current expression of our economy, let me say that one more time, for the expression of where the world's resources live, for the things that we need in our economy, we see that the top performer in terms of total trillions of dollars of value at the top of the list is Russia. Not what you expected to hear. Russia, with over $75 trillion worth of natural resources, including things like natural gas, oil, gold, timber, and all sorts of other things, including rare earth metals. Russia is hands down the single largest natural resource bank, the natural resource reserve in the world, and by a considerable margin. The United States coming in second, Saudi Arabia falling dramatically, and now in line with Canada and in line with Iran and China and others. And what's so remarkable about this graph is that we're seeing the global economy move in interesting ways. So we're seeing things like the emergence of the importance of China in the marketplace in terms of financial as well as industrial output, what you see is that China is still lagging. At number 6, it's still lagging as the ability to control its own destiny, making sure that we have a very clear picture on where it has to go to see the resources required for it to perform. The graph on the left is absolutely critical. And as I think Kelly alluded to at the opening, I'm going to be sharing these slides with IDTA. So everybody who's actually watching this is going to be able to grab this material, come back and revisit it, have a look at it, ask questions of it, go to the sources, and look more deeply into it. But I wanted to make sure that you had the ability to see that over the course of the coming months and years, understanding what's going on geopolitically and economically with Russia is going to be a massive signal of where we need to be spending time, effort, and attention to inform ourselves about what's happening in the future. And you'll see that as we look at that list, oil producers are starting to shrink in their relevance, rare earth metals, metals generally, and energy are increasing in their importance. And it's just a fascinating pivot that we're seeing in the world. But I wanted to actually put out a little surprise, a little curveball, because I always love to look at where top market performances are. And for those of you who kind of, want to give yourself a little bit of a challenge, it's kind of fun to look at this last graph here, which is the best performing equity market in the world, the one that actually in total return increased the greatest across the last year. And I'll tell you what, very few people would know that the Tehran Stock Exchange between February 2019, February 2020 was the top performing exchange with an increase of value approaching 270% return year on year. Now, I'm showing you that for a couple of reasons. One of the reasons I'm showing you that is because I want you to see what's happening with the shift of the global economy. A lot of that Tehran market growth is because the Belt Road Initiative in China and what's happening with the global energy supply, the global metal supply, and the global materials processing supply is actually changing where growth is. I'm not expecting you all to jump onto your spot market or your trading platforms and go, well, how do I get a piece of the Tehran Stock Exchange? I'm actually not recommending that, because it turns out that wherever you have high degrees of volatility, you also have very interesting effects of political, geopolitical, and other instabilities. But it's actually worth noting that during a period of time when the rest of the world largely didn't do very well, the Tehran Stock Exchange in Iran was a top performer. That's actually a fascinating little anecdote and a reminder that says that if we're going to actually be effective in our long strategy of how we look at the markets today and where we want the markets to go in the future, it's very important for us to keep a very global view of what's happening, where it's happening, and how we position ourselves to change. Let me close with the following. I've been advocating, as many of you know, for a very long time, that the way to approach the world is to actually ask very fundamental questions. And some of you are familiar with things like Maslow's hierarchy of needs. But I'm giving you a cautionary tale because as we look into the future, and Kelly and Cam and Lachlan always are delighted where I actually try to at least give us some forward-looking optimism after I tell you that the whole world is changing under your feet. The great news is that we can count on some very basic things. And the basic things we can count on is something I simplify in what I call the integral accounting process, which is I want to know that in any situation over the macro structure, and remember that we're talking about day trading, we're talking about dynamic trading, we're talking about fundamentals or algorithmic trading, and that's a wonderful place to be. But secular view should always take a step back and say, do I have exposure to the things that people will persistently engage and need, and around which markets will always take generally secularly positive action? And so to do that, we actually break the world into 6 components. Commodity, and you all know what I mean by that. That's the matter and energy. That's the stuff we use. That's the stuff that goes into stuff. Very simple. We want to look at something where about 1/6 of our energy About a sixth of our allocation, about a sixth of our orientation goes into something that's reflective of commodities. The next, custom and culture. How do we communicate? How do we assemble? How do we engage? How do we actually operate in this thing that we call the global system and the society in which we find ourselves? So that's communications, that's media, that's entertainment, that's all of the processes that allow us to stay in community and stay in a fluid engagement of the global trading and the global social systems and the global governance systems and the global commercial systems. So custom and culture, we need a sixth of our focus on that. We need a sixth of our focus on knowledge. That's things like education, online learning, certifications, qualifications, all of the kinds of things that are part of the way in which we maintain quality systems in our ecosystem. So those are very important things to make sure we consider. We also want to go into the fourth quadrant, or the fourth sextant, I guess it is, sixth of the wheel. The fourth one, money. How do we make sure we're exposed to financial services, financial sector? And I don't mean investing in asset holders. I mean investing in people that are engaged in the actual currency of monetary systems. So we need to make sure we have engagement there. We need to have the fifth of our six. We need to have in technology. How do we make sure that we're participating somewhere in the process whereby people are building out solutions that build opportunity for people to have ongoing fundamental access to things like transportation, lighting, logistics, energy transfer, etc. How do we bring those together? And last but not least, well-being. What are we doing to make sure that we stay human, stay dynamic, stay engaged, stay healthy, stay part of a living, breathing ecosystem where we're not just technically winding up making or holding on to assets, but we're actually enjoying the life that success affords. We want to make sure that we have those balanced. And I've done this now for our team over here in the United States and our broader global community for quite a while, but I wanted to show you what happens when we just do a simple comparison to that six-dimensional view of the market and how that tracks with respect to a cap-weighted or a fundamentals-weighted view of the market. Over the duration that we've been monitoring this particular strategy inside of our integral asset management team, we've actually shown that just in the past year, while we've had all of the interesting volatilities we've had across that year, an integral asset return has come in at 10.54%, while the S&P during the same duration has yielded 7.38%. Now, the rationale behind thinking about this differently, and I said before, you may be familiar with Maslow's hierarchy of needs. We're actually using this six-dimensional model as a way to approximate what we would call a Maslow-like or a enlightened Maslow model. We ask fundamental questions, which are, what do people always need? And then we start answering the question, how do we make sure we gain market exposure to those things? And so it's really simple. We need things like water. We need things like food, sanitation. Those are things that everybody needs. So how do I make sure I get exposure across something that I know is going to have a secular resilience that is going to outperform momentary volatility? And I want to make sure I've got a piece of that action. How do I actually get a piece of the action that says that we are going to continue the art of and the inelegance of communication? We're going to be involved in virtual summits, real summits. We're going to be using telecommunications infrastructures. We're going to be using satellite infrastructures and other communication systems. How are we building the infrastructure that is going to keep us connected? And how do I make sure I have some exposure there? How do I make sure that as we go to remote learning, online education, online awareness building, the Internet of Things, where we're going to have intelligent devices, not just intelligent people, how do I make sure I have a piece of that action? How do I make sure that I look at where things are going in the monetary system? How do I play things like virtual, crypto, blockchain? How do I bring an awareness of all of those things into a world where I know that there are system changes that are happening in our monetary and currency systems? How do I make sure that I'm intelligently participating in what those are without betting the farm on one or another protocol, which may exist today and may be gone tomorrow? How do I make sure I'm participating in the distributed networks? How do I make sure I'm participating in the internet security, data security, everything else? How do I bring all those things together? The answer to this, people, is that our goal is to make sure that when we look at the world, we look through a lens that says, how do we stay constantly informed so that no matter what happens in the future, we are at the cutting edge of asking the right questions at the right time and making sure that when we need to, we adjust our models to embrace a future and succeed in our pathway to success. And with that, I'm going to open up the floor for some questions. And here we go.
Hey, Dave, you never disappoint. It's like taking out a whole lot of rifles and go boom, 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 boom. I love it. I love it. Your playing field is very, very large. And of course, there's a whole opening of cross-correlated questions coming in. So we'll get straight into them, Dave.
You got
it. Okay, you got it. What is M&A from Vincent?
M&A, mergers and acquisitions. And people, here's what you want to do when you look at the growth. And by the way, we're looking forward, Kelly, we're looking forward to a very interesting period of time where companies are going to be acquiring growth. They're not going to be growing growth. And that just means that successful smaller companies, the small and mid-cap companies, are going to be acquired to keep the big guys fed, because they're not spending on their own R&D. They're not spending on their own growth. This is not an organic growth period. We are in a secular acquisition-oriented period. And because cost of capital is low and the availability of trading for equity is high, this is a time to make sure you have your eye on the prize. Because when those little mergers and acquisitions happen, that top line growth of the little companies is going to blow that company's value out of the water. It's a place you want to be playing.
Okay, awesome. Very, very clear. From Gary, is the traditional balanced superannuation portfolio of stock, cash, and property still appropriate, or should we push for a larger portion of any particular sector?
Yeah, so listen, be very careful about the correlation between cash and real estate right now, because remember that these things are correlated. As we see banking manipulate the value of a currency, we're going to see it show up in the illusion of property values going up, because remember, these things work together, people. And that's a great question. I love that question. And please do not do okay, and I'll use a term, Kelly, I apologize. Sometimes I use terms from my industry, but we want to make sure we don't get into what's called a clash risk. A clash risk is when we have correlated things that we've been told are separate. So I think I've got money and cash. I think I've got real estate. And I think those two things are two different asset classes, but it turns out that they are correlated and their liquidity is cross-correlated negatively, meaning that when cash becomes more problematic, real estate takes a dive. You do not want to be in that tailwind because it actually crushes you on both sides. Great question.
Awesome. I'm going to go out and buy a caravan, jump in the car, head to the mountains.
There you go.
Too much for me.
There's got to be some places out kind of west of Toowoomba that's,
Oh, there are. We have some people from Toowoomba on here, so I'm coming. I'm coming for you.
Toowoomba people. There you go.
Okay, next question. World view: is the cashless society inevitable? And the fear?
Great.
No, fear of government-controlled digital economies.
Yeah. Great question. Here's the problem, ladies and gentlemen. We have a real problem because the digital world is one strategic error away from disappearing. And listen carefully to what I'm saying. I've been a prophet in the wilderness on this one for a very long time. So let's just bear with me.
Stay with me.
The problem with digital currency and the problem with cashless society is that it puts all of our eggs on the telecommunications infrastructure basket. And here's the
Right.
problem. If North Korea, if Russia, if the United States, if China, if anybody decides to detonate a low altitude nuclear device, what will happen is an electromagnetic pulse will fry your communications network. It'll fry your phone. It'll fry your ATM. It'll fry everything. And the illusion of the digital future is in fact not going to be even relevant to discuss until we've solved the infrastructure problem of right now, our devices and our grids are 100% susceptible to a shutdown that can be done in an instant. And everybody who tells me, but the blockchain is distributed, you know what? You still have to have communication systems working. And we haven't cracked that nut, people. And until we crack that nut, make sure that you don't get too excited about your Bitcoins or your Ethereums or whatever other blockchain idea that you have.
Yeah, I get that. Akhil Patel yesterday, he agrees with that. No jumping, just sit, just slow down. As you said, health is very, very important in this process because it's stressful to feel like you're forced to make decisions.
That's exactly right.
You're unsure about, right? That's why we have professionals like you who are well informed, many years of information, watching that bell curve go up, go down, and everything's pretty much that we talked about in 2015 coming to fruition.
There you go. And I'll tell you, what a beautiful place to go. Kelly, you and Cam and I had this conversation. And the funny thing is, and I'm going to come back and you know how much I love Cam, and I know that he is a beautiful, level-headed, rational actor. And what I love about both of you in our conversations in 2015 is at one point, I think we were standing in Florence. And I think Cam mentioned something about how confident I was about some of the things I was saying. I want to be really clear, people. I'm talking about things that I'm confident about because I'm actually looking at the actual data. It's not my hunch. It's actually a data-driven analysis.
That's right.
And so what I'm advocating to you is, I'm trying to give you some expression of what kinds of data I consume. Not to tell you that that's the right data. It's just what I look at. And it turns out that what I look at leads me to having a lot of conviction. And the conviction I have has turned out, Kelly, in the last, now 6.5 years since we've been together. That conviction has been spot on. We've landed every time. And so I'm delighted to be reminding us all that this is about keeping open eyes. Don't look in the rear view mirror. Look in the windscreen, see what's coming at you.
And Dave, we are, Cam and myself, very confident about we're projecting ourselves, our life, our investments forward because we have people like you in our environment. And we only have a handful. I've got to say, chaos can be created pretty easy. We talk about fear, and you can respond very quickly. I highly recommend. There is so much information out there on all different platforms. People are asking me, who do I trust? What's an honest platform? And as you said, we're still moving all towards that communication system that we can all trust and know that we're there, but trust us, you're in the right community and the right environment. And as we receive information, when the data shows up and we can go check, tick, you will get the information delivered to you. So exactly back to questions. The squeeze on consumer and producer prices and the likely impact on inflation. The US government recently said that current inflation was a factor of supply chain issues and unlikely to be around for the long term. What are your thoughts and how do you see inflation play out over 22?
The good news is Jack Dorsey just blew. I usually like to be the bearer of the worst news, and then Jack Dorsey, the CEO of Twitter,
quite enjoyed that, right?
Oh yeah, I like to be the Grim Reaper. I don't think the Grim Reaper gets enough credit. But Jack Dorsey just did his interview that got published all over the place, and he's talking about hyperinflation being around for a long time. There's a lot of conversations going around on that, and the truth is, if we look at the last 3 quarters, we've seen 5.3%, 5.2% kind of quarter-on-quarter growth. That is That is
Yes.
1970s style. I mean, ladies and gentlemen, listen to what I said. That's 1970s style inflation. That's not where we want to go. And as a result of what has just been, kind of the long conversation I had, which, by the way, I recall either 1 or 2 years ago, Kelly, I actually mentioned that we were looking at a hyperinflation future. Jack Dorsey just made it worse than I even projected. But let's dive into where this is going. The fact is that we know that there is going to be a flood of minted currency that's going to hit the consumer spend, which is going to create the illusion that somehow or another we're kind of meeting that kind of supply demand curve of consumer product. Here's the problem. We've got and I'll use the US as an example just to make sure we're drilling in on this. We have what's called fractional reserve currency, and we have what's called fiat currency. And let's get those two things distinct, because it didn't used to require this, but we now have this distinction we have to make. If a government prints a dollar and says, I'm going to send dollars to people in the form of checks, those dollars have a notional dollar value the day they're printed. Mm-hmm. At the same time, most reserve currencies and most fractional reserve currencies actually are minted through the production of assets in the form of debt. So when we get a 30-year mortgage on a house or a 15-year mortgage on a house, that dollar of your house starts off as 8 cents and it matures to $1 over the duration of that financial product. Now think about what happens. In your wallet right now, no matter where you are on earth, you have two different kinds of the same currency. You've got one that was minted by a manipulation and another one that has a duration match that says that it's a fractional reserve match. If you think that those are the same, you are wrong, and inflation is bigger than you think it is, because inflation is actually a function that must take into account the increased supply of the non-fractional reserve dollar. That, people, is terrifying, because if we actually measured the real inflation right now, we would actually have to take a function of the manipulated printed currency and actually overlay that on what we're calling inflation. And what we'd see right now, Kelly, depressing news, it looks like we're currently sitting at about 13% inflation, not 5%.
Yeah. The illusion, right?
Yep.
The real deal. Yep. That sounds irrational for some, rational perhaps for some. It's an interesting world, and it is an illusion, and we've been living in this a very long time. I'm a little like you. I shoot straight. This is the reality. This is the data. This is where we said we'd be, and we're right there. It's a little bit like what you're being told, depending on where you're listening to the information and what the reality of researchers are showing you, likened to Dr. Dave Martin, likened to us in our community, is the real deal. So
that's exactly right.
Yeah, it's an interesting time we're in. Dave, I have a question here. I find it's interesting. It's very simple from Kaka. What should a normal person do? Who's normal these days, right? I think I'm pretty normal, but
buy a bow tie. Buy a bow tie. No, I'll tell you, you got to buy a bow tie. That's the answer. You got to buy a bow tie. In fact, what we ought to do is auction this and do a fundraiser for your award recipients, for your top graduates.
I especially because that was the one, right, that we used way back in 2015. You're wearing the same one today, and I got to tell you that in both photos, it is tipping a little. It is tipping the way I'm seeing you, a little up on the right, down to the left.
Okay,
so there's got to be like
an extreme close up, right? These
are
the mythical.
A market indicator.
These are the elephants from Disney's Fantasia. These are the dream elephants from Disney's Fantasia. That's what's on these ties. That's pretty cool. But that's a great question. Let's actually answer it. So what does the normal person do? I'm gonna give you the answer I try to give everybody. Pick one of the simplest things that you value the most. And I'm going to give you two options: water or sanitation. I can guarantee you that as long as humans are moving around on this planet, those two things will have to be part of the human experience. And as a result, they will have to be part of your portfolio. If you want to move out of the world of classic asset allocation and move into intelligent investing, and you heard what I just said, move out of asset allocation into intelligent investing, have a piece of the pie of something you will guarantee cannot go away. Because as long as we are human, we are going to need water, and we're going to need to do something with what comes out at the end, right? It's just basic fundamentals. So if it ain't going in one orifice or coming out the other orifice, you probably got some latitude. But those two things are going to be, for as long as there are humans, those two things are going to be critical. Make sure that you use your basic reptilian brain and go, hey, I know everybody's going to need this. I know everybody's going to want this. And I want to know that my safe investment is something that humans cannot live without.
Wow. I know that there were so many things in there that you tipped into, and I'm like, oh, and there's that, and there's that. We need like a one-on-one where maybe we do a bit of a private session in the near coming month to 6 weeks before we go into Christmas, if everyone sees that valuable.
Let's do that.
Yeah.
I would love to do that. And I would love to bring our communities back together. Listen, we're in a time, and it feels strange because we're, far apart and we're not traveling as much. And we got all those challenges. But let me tell you, we're at a time where there will be those of us who are connecting like this. And we're bringing our communities together. We're connecting like this. And I'll tell you what, together we'll be smarter. We can actually start sharing information. We can share ideas. We can have an amazing conversation, and it's absolutely critical. So, hey, I'm all about it. Kel, Cam, Lachlan,
yeah, awesome.
That this is about being a team player, because we're going to cross this finish line successful, thriving together. This is the pathway to win, people. This is not the pathway to survive. This is the pathway to win.
I agree, and it's not a small conversation, because I can see so many questions coming in, and I can think, well, that opens another box and another box, another box. So what I will say, so that you can all feel that you've been heard and your questions have been answered, what we will do, and stay tuned to this, that we will have, I will talk to David after this, we'll start merging our communities even tighter, because we have an asset management company as well, and all our clients are asking, what do I do? Where do I put my cash? Should it be in fiat? Should it be in crypto? Should it be in property? Should it be in assets? What assets? And we can answer these questions, and at least you can feel confident and positive that you've got a hold on some trusted information from people that have done the research. So I feel that could be an awesome next step, Dave. And we've always, personally, we have our merge communities and merge conversations, but I think that's where we go before Christmas. If you're up for it, I know that you are exceptionally busy.
I'd be delighted to. And in the meantime, Kelly, Cam, and Lachlan, if we want to, I'd be happy to work with your community. We have a platform called the Fully Live Academy. It's at fullyliveacademy.com. We have a bunch of this content, which is already up online in various courses. And one of the things that we can do, and we haven't even talked about this, but we'll find a way to actually maybe offer your guys some discounts to come in. Like we'll figure out a way to do this, because people, we really, really, really do want to see all of us come across the finish line and succeed. So make sure, if you have questions, check out fullyliveacademy.com. Make sure, and Kelly, Cam, and Lachlan, let's have a conversation offline. Let's figure out a way to make something where each member of your community gets a discount to jump into some of those advanced courses. Because we do want, like I said, we want to cross this finish line thriving together, not getting by. We want to be thriving. And I am watching the snow start to set, and I'm really grateful that we had this time together.
Oh, me too. And I'm very, as my 21-year-old daughter, she just turned 21. says,
Congratulations.
I'm jelly about that. So I'm so jealous that you're in the snow. We'd love to be there as well. And Dave, we've put all the links in the chat. Everyone gets a resource that arrives out in your email. Look for that. Everything that we can consume from this conversation. And I want to say, please send love to that beautiful wife of yours.
I will indeed.
I was at your wedding. You're at our wedding. You know, what a journey we've all had.
Yeah,
And,
beautiful.
You know, we're just so grateful. It is time, everyone, to interconnect our communities together. All right, you're never going to be left alone. Stay tuned, stay involved. And what I would say is clean the slate of all the illusion, you know, all different people that you're listening to, that you're acting upon. Realistically, it is about, and Dave, you have a side on this. It's activating humanity, activating what we know is logical to us. And I do have Lockie on the screen. I just got a feeling Locke might want to, Dave loves the information, is on board 1,000,000% with us. We have great personal conversations about this. So Locke, have you got something you'd like to, I thought so, connect in with Dave?
Look, I've got about 400 questions, but Dave is not available for the next 8 hours. So I'm.
We'll do another conference. There you go.
Yeah, look, I've got guys, can I endorse Dave? He doesn't need any endorsement, but I've been following Dave since we met, and the guy is a legend. There's no question about it. When I'm about to show you a static bar reversal, sure. I think actually, Dave, on that, but I think day trading now, with all of this uncertainty, day trading is actually coming into its own, because if there is a global correction or a geopolitical announcement, or Trump brings out another social media platform called Truth Social, for those that don't know, it doesn't matter for us. Our average trade is 5 to 7 minutes. So just get in, out, get the job done, put the money back in the bank. But I've been actually on your website. I'm on the MCAM website looking at your funds, because I think there's a stunning partnership between BCAM and MCAM. They happen to almost rhyme. so
that's just a coincidence, right?
It feels like we were made to make this work. There you go.
I reckon BCAM, MCAM, that's a very exciting 2022, and I'll zip my lips and we'll be in contact.
You got it, man. Hey, listen, and guys, make sure, I could not suggest more strongly, make sure that you realize we're living in a time where the cool thing is arbitrageurs are opening up in an instant. Literally, a statement's made, a thing is happening. And what we need to be is on the top of the information, be nimble, be responsive, and be measured. There is no bet. Listen, when we have a world that says that we've got a quadrillion in derivatives, here's the message. The message is never think that you can ride a thing too long, because the problem is there will always be a too long. Make sure you're moving, make sure you're nimble, make sure that you're part of a solution. Do not ride things where you think you've got, hey, I got my heart in it, I got my conviction in it. I'll tell you what, right now, the fact that the derivative market's where it is tells you that everything that your emotions want to do is going to be wrong, and everything your actual brain and data tell you to do, lock it in. Be disciplined, be responsive, be on top of these things, but never get emotionally involved.
Wow, that is awesome, because I'm just going into a masterclass about discipline and emotions. So, and we call that, Dave, we do call that BHP, buy, hold, and pray. Don't be doing that in this market, because you'll be doing a lot of praying, a lot of time on your knees.
Exactly right.
Yeah, so we want to take this moment to thank you, and this has even synergized us further. We're interconnected. We're going to blend our communities even further, and you'll be hearing from us around that. So, Dave, head out there, throw your skis on or your snowboard, go and enjoy that snow, or even just a little snowball. We'll see you on the other side. Thank you, Lockie.
All right.
Thank you, Dr. Dave Martin, everybody.
Guys, and a big hug from, my favorite Australian, who's got that beautiful, fuzzy, fluffy hair, and, has as big as the universe. I know that she is looking forward to the day when she can wrap her arms around a bunch of you guys again. But between now and then, feel virtually hugged from Dave and Kim Martin, and know that we are in your corner, and we're always here. And Kelly, Cam, Lachlan, as always, thank you so much. It's an honor to be here. Anything we can do to help advance the cause, we're all about. Take care.